Just waiting on the go signal from IT.
You have to go ahead.
Okay, good evening, ladies and gentlemen. This special meeting of the Government Employees Retirement System Board of Trustees for November 18, 2024 is hereby called to order. Can I have a roll call, please, Mr. Administrator?
Yes, good evening, Mr. Chairman, to all. Trustee Nellen L. Bowery. Trustee Nellen L. Bowery. Trustee Bowery absent. Trustee Andre T. Dorsey.
Present.
Trustee Dorsey present. Trustee Vincent G. Liger.
He's excused.
Trustee Liger excused. Ex officio member Cindy Richardson. Member Richardson absent. Trustee Ronald E. Russell. Trustee Russell absent. Trustee Leona E. Smith.
Present.
C. Smith present. Trustee Dwayne A. Callwood. Trustee Dwayne A. Callwood.
Oh, present.
Trustee Callwood present. Mr. Chairman, 3 present, 2 absent, 1 excused.
Okay, I'm seeing Mr. Bowery. His device is online. Give me 1 second. Let me try to call him. Okay, Mr. Dawson, I see Mr. Bowery now.
Trustee Bowery. Trustee Bowery, are you present?
There's a message on his device saying connecting to audio.
Or shall we record him as present, since he appears to be on the conference?
Yeah, Mr. Trustee Bowery, give us a mic check. It's still saying connecting to audio. Let's give him a minute. I don't want to start it unless I know for sure he could at least hear us.
All right.
Okay, let's give him a minute. He's having some technical difficulties. He can't hear us. Neither can we.
Be connected on 2 devices. I see him on one.
Okay, Bowie, unmute your mic and see if we could hear you now. Yeah, we got you now.
Okay.
Okay, Mr. Darcy, you can go ahead and record him as present.
Yes, sir. Trustee Bowery, present. Mr.
Present.
Chair, 4 present, 2 absent, 1 excused.
All right. We have a very short agenda today. The first item is a recommendation coming out of the investment committee meeting, a recommendation from our investment advisor that we make a slight tweak to the allocation, the asset allocation within our portfolio. The underlying purpose being that we had a good year in the market last year, and the recommendation is that we take some of our profits or winnings, if you're a gambler, take some of that off of the table.
Which we're not.
We're not.
Okay.
I'm just for the people who, so everybody could relate.
We would not want to misquote.
Take some of our earnings out of the riskier part of our portfolio and move them over into a less risky portion of the portfolio. Who we have from Makita? Sean, Mr. Bowen.
Hey. Yes, Sean from Makita. Leo should join in a little bit, but I can start.
All right, go ahead.
Do you want me to share my screen, or do I have that ability?
Yes, I think you should. I think you can.
All right.
Point of information, Chair.
Yes, Trustee Dorsey.
Where was the recommendations as to where we would park that money?
He's
Funds. Hello?
I'm sure he's going to get into that now. So you're moving up more over to the bond side.
Okay.
Out of the stocks and
Okay. I'm good with that for sure.
So,
Okay.
So explain to me what the rationale is again.
so can everyone see the screen that I'm sharing?
yes,
Yeah.
I can see it.
Okay. So to take a step back, our recommendation is to move 10% from equities and put 10% into bonds. A lot of that is because of 2 reasons. One, with the lower funding note contributions you've gotten. Also, with this equity market rally that has happened the last 18 months, it's in our view, a good time to take some winnings and rebalance them into bonds. So that's on the surface what the recommendation would be. There's also a tweak within international, developed, and emerging to just shift those 1% each, more so just to align yourselves better with the broader market. No changes to policy ranges. They're obviously very wide, as you can see here. And we provide some thoughts as to why this should be the case. So the last 2 years, you've had these really good returns, especially the last year for the fiscal year, and those who weren't on the other investment committee call, 24.3% for the fiscal year return for 2024. That's following a good year of almost 9% from 2023. So we're considering the main thing for your portfolio is reducing the volatility, because you really can't have a big downturn with the lower amounts of the funding note coming in. Because as you all recall, not only are the amounts are going to get cut down coming up, combined with you didn't get as much as you should have the last 3 years, or the first year it was made up. But so in conjunction, that's kind of the thesis of why we think it's a good time to rebalance more into bonds. So I think that would be one aspect. We do have another recommendation to tweak your U.S. equity portfolio, which I can either do now or wait to take any questions specifically revolved around broader asset allocation.
Okay, Mr. Chair, I have one question.
Go ahead.
For the chair. Okay, Mr. Bowen, in regards to, you're saying 10% of the bond, what dollar figure are you talking about? Do you have like a dollar amount to put into bonds?
Yeah, it's on one of these
Because you're
pages.
saying 10%, but do you have a dollar amount?
Yeah, so if you go to, let me get to that page. I don't see it here. So it would be 10% of,
The portfolio?
yeah, it would be 10% of the portfolio moving. So as of October, I have your October performance numbers here. So you'd be moving about 50 million.
Okay, 50 million. And then the follow-up question is, then you will have to, then the board will have to go out and do due diligence and selecting a bond manager.
No, so you have already, I can go right to your portfolio here. You have a investment grade bond manager already, SSGA. A lot of
Oh,
most
State
of
Street.
your,
Yeah, that's right.
yeah,
Okay.
State Street. So we'd simply be
Okay.
moving to this fund. We'd add another 50 million.
Okay. But it's not that we adding a manager or anything like that. I'm just gonna remain with State Street.
Correct.
All right. Okay, thanks.
Mr. Chair, Ronald Russell present.
All right, Mr. Dawson, record Trustee Russell as being present.
Duly noted. Marked as present.
So summarize that again for me, make sure I understand it. We're moving 10% of the portfolio from one asset class, asset allocation, which is the higher earning, but also the more risky.
Correct. So US equities are potentially higher returning asset class, but comes with a lot more risk profile or standard deviation, volatility.
Yeah.
We'd move into bonds to lower that. And, I think if you look here, your volatility moves down by 1.5%. But over the longer term period, you're not giving up. I mean, you're giving up some return, but not really as much. You'd still have a probability of that 6%, well over 50%. So it's looking longer term, but it's also kind of a tactical move to take advantage of the gains that you've had over the last 2 years. I think it's when we talked at one of the retreats in July, we always would show a sequence of return analysis where this portfolio could not afford to have bad returns at the start. And really, one of the best things that could have happened is having these really good returns at the start. So it's really just to lock in some of those gains. You're still going to have, 50% or 55% of the portfolio in equities. It's just taking some of that risk off the table.
Okay, so we're still staying within the equity classification. Or we're moving from US equity to, so that's the piece I'm not clear.
We'll have 35% remaining.
Yeah, so you would be
Yeah.
moving, right now you have 45% in US equity. You'd
Right.
move that to 35% US equity and take the 10% and move 10% from investment grade up to 20%.
Oh, okay. And the rationale is that we're trying to lock in the gains. I guess the assumption is that we can, how much we're earning over the last 12 months or so on US equities?
On US equities, I can go
Roughly.
back here. For the fiscal year, you gained 35% return in US equities.
And your justification is that the assumption is that that can't be expected to continue.
We don't have a crystal ball, but
Yeah, I understand.
yeah.
So you're moving it into a less risky, but we're still in equities, but a less risky part of it. Is that what it is?
We're reducing the amount we have in the risky asset class.
Okay, so we're moving from equities to bonds.
Yes.
Okay. Okay.
Any other trustees have questions for Mr. Bowen before he moves on?
Okay, so he's gonna want an okay from the board to do that, or is now the time to do that, or are we gonna wait till the end of his presentation?
I think we should wait till the end of the presentation.
Okay.
All right, go ahead, Mr. Bowen.
Thank you. So that was part one. Our part two of our recommendation is to tweak your U.S. equity exposure. So within that bucket that is now going from 45% to 35%, we're strictly just talking about that portion of your portfolio.
Mhm.
So as I had mentioned, this is all as of 9/30, but you have 100% of your U.S. equity exposure in the Russell 3000 index managed by State Street. And our thought is the Russell 3000 index is very heavily skewed to large cap stocks. You can think of the Magnificent Seven, Apple, Microsoft, Facebook. It's very heavily weighted to those. So you have a lot of exposure there. So your biggest portion of your portfolio is also highly concentrated in these companies. Our thought is you can deconstruct this portion of the market into large cap stocks and small cap stocks. So our recommendation, and I have some other pages here, is to break out your Russell 3000 exposure into dedicated large cap and small cap. That way, you can take a better advantage of different opportunities within the market. Recall you take roughly 15 to 20 million out of the fund every couple months. This would give us another lever to pull strategically from a certain part of the market. So say small cap stocks did well recently. Let's just say that was the case. We may want to pull specifically from that part of the market to lock in some of your gains and take them out into cash for benefit payments. This just is giving us another avenue to do that. So I guess this is a good way to explain it. So your Russell 3000, which is the current one index fund you have, has about 80% to the large cap stocks, as I mentioned. You don't have a lot of exposure to the smaller part of the market and the mid cap part of the market. What we're proposing is to break it out so you now have a Russell 1000 fund and a Russell 2000 fund. So you would have more exposure to the smaller part of the market. Also, the Russell 2 is less correlated to the other. So it gives you a little bit of a correlation benefit as well. Here we kind of show some reasons why. I think this breaks out where you can show the Russell 3000 is pretty correlated to the Russell 1000. The returns are pretty similar. Russell 2 is different, so it gives you the benefits of diversification there. We talked about this at the other investment committee meeting, but looking at it from a PE ratio, large cap is very expensive right now. Small cap is cheaper, so could be a good time to get into this part of the market as well. So here, this shows kind of our proposal would be to go from the left side of the screen, which is 100% Russell 3000, to 85% Russell 1000, 15% Russell 2000. So in those dedicated index funds within SSGA. Dollar value is on the next page. Again, these are as of 9/30, so we would just adjust these as of when we got into the funds. But you'd basically have about 210 million with the large cap fund, Russell 1000, and 35% in the 2000. So again, it's just being able to take advantage of the, different opportunities within the market, especially because you need to pull the benefit payments every other month or so. Any questions?
Chair, I have a question.
Go ahead, Trustee Dorsey.
So, just for clarification, when you were saying that the larger caps are more expensive than what you said, I didn't catch that.
So the large cap stocks are more expensive part of the market right now. They've been really bought up. The price to earnings value numbers are high compared to small cap, which have been depressed as of the last 3 years or so, and they're perceivingly a better entry point into that part of the market.
Okay, so the large cap you're referring to, I think that's what you pulled out sometime back, maybe earlier in the year. I think it was maybe.
I think our reporter is probably gonna have trouble recording Trustee Dorsey because I can't hear him. I don't know if she can.
Hello?
I'm not hearing him either.
Hello?
I am not
We
hearing
can
it.
hear you.
That's
We can
much
hear
better.
you
That's
now.
much better now, Dorsey.
Hello?
That's much better now, Dorsey.
Okay, so what I was asking in reference to the large cap being more expensive, were these the stocks that you pulled out maybe early in the year? I think I had made a request of those that were our top performers. Are we talking about the same stocks? Well, these were mostly, I think they were, trying to remember, I think they were like Facebook. You had pulled out maybe about 7 or 10. You had a sheet, one of the pages in the presentation earlier in the year. Are those the ones you're referring to as expensive?
Correct. So what I believe you're referring to is earlier in the year, we showed a breakout of what your holdings were, what companies you actually owned. And the concentration of those are in Facebook, Apple, Microsoft, those funds, or excuse me, those companies. And yeah, those are the ones that have the higher price to earnings.
Okay, but those companies are doing really well right now. I mean, they are really doing well. So I'm just trying to get your thinking on going into the smaller caps. Are you looking for those to start to pick up as well? Is that the thinking? Is that the strategy?
I think it's twofold. I think we're starting to see hopefully some signs of the U.S. equity market broadening. So small caps coming back on returns and having better returns. You're not going to be getting out of Facebook and all of those completely. You're still going to have 210 million in the Russell 1000, of which all of those companies I just mentioned are the biggest the biggest companies in that fund.
Okay, I got you. So we'll still be on that ride. So I had another quick question though. With the changing of the guards, in terms of our presidents, what are you guys projecting? Because the market is still moving in a forward position at this point. What are your projections on that with the new president taking over in a few months? What's your strategy? What are you guys discussing that you can share with us, I guess?
I think that there's going to be some disruptions. I think, this is me personally speaking, not necessarily Makita, but I think there's a lot of unknowns, right? And I think the best position to be in is a diversified portfolio that you have across all the various asset classes in the public markets to take advantage of any type of dislocations. So you don't have all your eggs in one basket of the market. And because there's all these unknowns, I think, 6 months into his term, we can kind of get some insight of where his policies are going, and then we might have a better predictor to make some judgment calls. But as of right now, I would strongly lean on diversifying and taking risk off the table. And I think both of these moves would do that, moving the 10% into bonds and broadening out your equity exposure to include more dedicated small caps.
So you realize that the president-elect has indicated that he will be reducing corporate tax across the board, which, where I sit, that's a built-in income profit for those corporations that are. So that's why I was asking what it indicate that.
Dorsey, you fade out again, Trustee Dorsey.
Hello? Hello?
Yes, we can hear you now.
Yeah, I was saying that to Makita, the president-elect has indicated that he is going to reduce what he started when he was in before, reducing the corporate tax. So that would be a profit, a built-in profit for those companies. So I was wondering if you were looking at his policies, what he was proposing. That's really where I was coming from. If you had any comments on what he was proposing.
Along those lines, Sean, Makita sent out today a pretty good policy communication that I think, I'm not sure who's on the circulation, but I certainly got it. So I'll share that and give some insights.
Oh, I'm not on that.
Dorsey,
What's he referring to? What's he referring to?
It's an email that was sent out by Makita, one of their periodic emails. The title is New Administration Potential Policy Impacts. So that would be along the lines of what you are inquiring about.
CEO, is that something that normally comes out from Makita on a quarterly basis, semi-annual, yearly basis?
It's periodic.
Yeah, this came out because of, what happened with the election.
Oh, okay. Chair, did you get a copy?
No.
I didn't hear you.
No.
No. Okay. I like to get a copy, Chair.
Dorsey,
I will make it a point to forward it to the trustees.
Okay, thank you.
At the end of the day, time I'm on that situation, let me think out and that, so I'm answer a lot of things.
No, this wasn't
No. I'm not talking about thing. I'm just saying in terms of talking about policies. I'm answer a whole lot of things. So that's a big.
I think Makita wisely did not address the eating of cats and dogs.
I'm just saying. All right, any more questions?
Yeah, I had one more question for Makita. The slide you had where you were talking about the percentages, can you put that slide back up a minute? The Russell 3,000, 1,000, 2,000.
This one?
Yeah, I had a question on this one, and then you had one which showed the different percentages where I guess you were recommending across.
Trustee Dorsey.
Uh-huh.
I don't know if you move in like close and back from your device, but you'll be good, and then you'll fade out and you'll come back. So
okay, so the slide that's up now, are you suggesting that we go with these percentages that you have on this slide from where we're at in the 3,000 to the 1,000 and the 2,000? Is that what you're recommending?
No, so this page is just showing you which market caps all these indexes are in. So this is market cap exposure of these funds. So it's basically just trying to show you that the Russell 1000 is very correlated to the Russell 3.
I got you. Okay, then you had a next slide that had percentages, maybe before this one.
This one.
Yes. So were you recommending that this is where we move to, or this is where we're at now?
So your current is on the left, and we are proposing or recommending that you move to the percentage on the right.
Okay, I got you. Okay, so when we do that, what percentage will be left on the current?
So I guess it's not on here. That's a good question. We would be terminating the Russell 3000
I got
and
you.
then deploying into the Russell 1000 and 2000 at these
No, I
rates.
see where the percentages add up to 100%, but I was just curious about that. Okay. All right, thank you. Thank you.
Sure.
Trustee Bowie, you have a question?
Yeah, it slipped my mind. This old age ain't working good for me at all.
Okay, if you come back, let us know. Any other trustees have the question?
So just to summarize what the recommendation is, um, if I have to write it out in one sentence, we're moving out of one asset category into another. You moving 10% into another asset category, investment category, that potentially offers a lower return, but also lower risk. And so it could be characterized as a conservative move to lower risk. And then within the new category, we're also doing pretty much the same thing. We move from Russell 3000 to breaking that up into the other two. That's also a move in the same direction, right?
I wouldn't say the second one is a more conservative move. I would say it's a diversification move. It gives you, like I had mentioned, another way to pull money from the marketplace when you need to raise cash for benefit funds or benefit payments.
Oh, okay. Now, earlier, there's something you said that you answered to a question, and you said that's not Makita's position, but that's yours. And I'm a little bit concerned about that, because, okay, let me, as a board member, when we make this decision, I feel very comfortable making those decisions if I know that it was based on the advice of our investment advisors. So this recommendation that's up on the screen and the one before that, that's a Makita recommendation, right? That's
Correct. So these recommendations in print in front of you are Makita recommendations. I was just talking about forward-looking, what no one really knows because no one has a crystal ball.
Oh, okay,
That was-
okay. I just want to clarify that. I think I feel comfortable that I've fulfilled my fiduciary responsibility as a board member when I make decisions based on the advice of whether it's advice of counsel, advice of investment advisors. So just wanted to clarify that.
With age is wisdom, Trustee Barry. Sean, would you also say that there's more upside potential in terms of price earnings ratio and dynamic with the small caps and more downside potential with the large caps in that regard?
I think if we always say some sort of reversion to the mean, and where the large caps are so expensive right now,
Right.
they have a potential to revert back down to the mean. I mean, I think we try to look at things over a long period of time, 20 years, and those averages are even longer than that. So I think I can go back to that page, but I think the lines are the averages, and you can just see, I think where with your cash flow situation, it would be a good idea to kind of bring some of the cash into the small cap portfolio.
Was that a long yes?
That was a long yes.
Oh, okay. Thank you.
Any other questions for Mr. Bowen?
Yes, Chair, I had another question.
Go ahead,
So,
Audrey.
so you're saying that those caps are expensive. Those stocks are very expensive in that index. Uh,
Can't hear.
Dorsey, you're muted.
Hello, can you hear me now?
Yes.
Yeah.
Hello? Yeah, I wanted to go back to that because it seemed like something else triggered in my head with the last conversation. I had another question in reference to, you keep saying that the stocks are expensive, which is, I guess, to be expected because they're kind of like moving the market right now. But also in between that time, they've had stock splits. So do you account for that when you talk about that they're expensive because they come down to sometime less than half of where they're trading at in that index? So do you account for that? And then I was trying to equate that to, you keep going back to moving into the other Russells because of our cash flow. Is that really the justification, the cash flow portion of it, so we can have easier access to the cash?
To answer the second part first, no, the cash, either fund, you get its same daily liquidity. You can get the cash within 1 or 2 days. I was more so trying to drill home the point that if you're in a situation where you need to raise 20 million, if small cap has done really well in the last month or two versus large cap, you're able to strategically pull it from small cap where it's had a good run in the last, month or two. That's the diversification benefit I was talking about.
Okay, okay.
And to your first point, the PE ratios they're more so looking at, price to earnings in the sense that versus large and small cap, like let me go back to the chart. I don't think this is going to be able to go up forever. Like I had said, to kind of reversion to the mean at some point. But yeah, we are taking into account all the stock splits that you mentioned.
Okay, so are you, I don't know if that's your responsibility, but do you track the stocks in these particular funds, like these particulars in the larger caps? They've been also buying up industries or other companies that enhance their position in the marketplace, which is also helping to push up their prices. So are you guys tracking all of that as well?
I mean, these are index funds, so we're really not tracking that per se. It's the index is the index. I mean, I think we're looking at, bigger term things.
Okay. That was just a question. Okay, I appreciate that, Chair. Thank you.
Trustee Russell.
Yes, I'm here.
I hear from you, Alec. You have any questions?
No, not right now.
Okay.
I think he explained it well.
Okay, cool. Just making sure.
Thank you very much for the consideration.
All right. Any trustees have any more questions for Mr. Bowen?
I had a question to the CEO, what the CEO's position was on this as well. What's his feelings on this? I'm sure he's had a chance to go through it as well. But overall, what is your look at this, when you look at it, what's your feeling?
Thank you, Trustee Dorsey. As I indicated in the investment committee meeting, I certainly concur with the recommendations of Makita with regards to the shift from of 10% from 10 percentage points from equities to bonds, capturing some of our winnings, so to speak, going forward. And then furthermore, with the redistribution from the Russell 3000 to the 1000 and the 2000, which I think gives us some more granularity in our holdings and some more flexibility, as well as possibly, as I indicated a short while ago in my question to Sean, giving us more upside potential with the small caps and minimizing some of the downside potential with the larger caps, given the reversion to mean that that he outlined.
I really appreciate that, CEO. Thank you. Thank you, Chair.
All right, Mr. Bourne, are you at the end of your presentation?
Yep, that was the two recommendations we had for you.
Okay, so we need a motion to authorize Makita to redistribute 10% of our domestic equity holdings towards the bond portfolio. Is that correct?
So move.
Point of information, Chair.
Why don't you do it as one motion?
Yeah.
Well, let him finish and then I will just say move. I thought we were doing it one by one. Are you doing it in a package?
Oh, okay. So
I just did one by one in case somebody will come.
Yeah, I said so move.
So
I move on the first one.
Move by Trustee Smith. Is there a second?
Second.
Seconded by Trustee Dorsey. Can I have a roll call, please?
Yes, Trustee Bowery.
Yes.
Trustee Bowery, yes. Trustee Dorsey.
Yes.
Trustee Dorsey, yes. Trustee Liger, absent. Trustee Russell.
Yes.
Trustee Russell, yes. Trustee Smith.
Yes.
Trustee Smith, yes. Trustee Colwood.
Yes.
Trustee Colwood, yes. Mr. Chairman, 5 yes, 1 absent.
All right, thank you. And then the next motion would be a motion to authorize Makita to redistribute the holdings from the Russell 3000 index fund into both the Russell 1000 and the Russell 2000.
So move.
Moved by Dorsey, Trustee Dorsey. Is there a second?
Second.
Seconded by Trustee Smith. Can I have a roll call, please?
Yes.
That's at the 85-15 split, right? It's understood. Yes.
Is implicit?
Okay. Okay.
Confirmed? Trustee Bowery?
Yes.
Trustee Bowery, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Liger, absent. Trustee Russell?
Yes.
Trustee Russell, yes. Trustee Smith? Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Colwood?
Yes.
Trustee Colwood, yes. Mr. Chairman, 5 yea, 1 absent. You're muted, Mr. Chairman.
Oh, sorry about that. Okay, the motion carries. The next item on the agenda is a letter received from the Governor of the Virgin Islands. I'm going to ask the board secretary to read the letter into the record.
Yes, Mr. Chairman. Letter dated November 8th, 2024. To Mr. Dwayne Colwood, Chairman, Government Employees Retirement System Board of Trustees. Dear Chairman Colwood, I'm writing to formally request that the board reconsider and rescind the recent resolution to raise the employer contribution by 3%. At this time, this adjustment would place an additional $14 million burden on the government of the Virgin Islands, which is simply unsustainable under the current financial circumstances. As you are aware, we're still awaiting Congress's consideration of the rum cover-over tax extender, which is expected to reimburse the government employees retirement system with $90 million. This potential reimbursement is significant and will alleviate some of the financial strain on our retirement system. Raising the employee contribution at this juncture before Congress has made a determination would be premature. The Virgin Islands have already committed nearly $3 billion to address the retirement mandate, demonstrating our firm commitment to resolving this critical issue. However, we are at a point where additional financial pressure would be counterproductive to the progress we have made. We kindly request that the board reconsider this measure at a later time. By then, we hope to have clarity regarding the renewal of the rum cover-over tax extender and the reimbursement of $90 million. Should Congress not act by that time, we will reassess the situation and explore what can be done. Thank you for your attention to this matter, and I look forward to continuing our collaboration in securing a sustainable future for our government employees' retirement system. Respectfully, Albert Bryan Jr., Governor.
All right, thank you, Mr. Dawson.
Welcome.
I just want to put a few items on the record before I open up discussion. Okay, item number one. At the time of the special purpose vehicle documents were executed, the GRS actuarial determined unfunded liability was north or exceeding $4.6 billion. So even if the GRS had received an immediate infusion of $3.6 billion cash on day one of the SPV, the system's unfunded liability would have been in the neighborhood of $1 billion. Item number two, contrary to what has been reported in the media, the board's decision to increase the employer contribution rate by 3 percentage points was not a result of any shortfall in the rum cover-over funds due to the system. Item number three, in 2022, the former GRS administrator, Mr. Arsene Nibs, as part of GRS's annual operations overview presentation to the VI legislature, requested that the 34th legislature fund the 3 percentage point employer contribution rate increase as part of the GVI fiscal year budget of 2023. Even though by statute, the board had the authority to implement the increase effective January 2025, and Mr. Nibs made that clear in his presentation to the legislature. In 2023, the current GRS administrator, Mr. Dawson, made, as part of the GRS annual operations overview presentation to the VI legislature, he made a request of the 35th legislature to include the employer contribution rate increase in the GVI fiscal year 2024 budget. He also reminded the body that the board had the statutory authority to implement the increase effective January 2025. 5, during this year's budget season, the GRS's scheduled annual operations overview presentation to the VI legislature was canceled by the legislature. Subsequently, a new date of September 3rd was given. I must note that that is late in the budgetary process. Nonetheless, Mr. Dawson advised the legislature at that time that the board had indicated its intent to implement the employer contribution rate increase effective January 1, 2025, as allowed by statute. 6, despite the multiple requests to have the employer contribution rate increase funded in fiscal years 2023 and 2024 GVI budgets, and the indications that it would be coming in January 2025, the employer contribution rate increase was not included in the fiscal year 2025 budget. 7, during the board's September 26, 2024 meeting, the board performed its fiduciary responsibility and passed a resolution to increase the employer contribution rate by 3 percentage points. 8, As a matter of full transparency, by the September 26th date when the board formally adopted the resolution to increase the employer contribution rate, the GVI fiscal year 2025 budget had already been completed. 9, the governor requested a meeting to discuss the employer contribution rate increase. Myself, along with the administrator and the actuary, met with the governor and members of his financial team. We went over the actuarial projections so that it was clear to the administration what the outlook for the GRS is. 10, the creation of the SPV by the plan sponsor pulled the GRS back from the brink of imminent insolvency. Had it not been for the efforts of the 34th legislature and the Brian Roach administration in creating a special purpose vehicle, we may have very well been meeting this evening to eulogize the GRS. 11, I believe the efforts of the plan sponsor in creating the SPV has earned them some quote unquote goodwill, and I say that for lack of a better term, with the GRS. And finally, I am not in favor of rescinding a resolution that we passed to increase the employer contribution rate by 3 percentage points. However, I am in favor of a compromise, and the compromise that I'm recommending to the Board of Trustees is that we modify the resolution to change the effective date of the employer contribution rate increase from January 1, 2025 to October 1, 2025. The new recommended date of October 1, 2025 gives the plan sponsor 9 months of relief, the opportunity to work the increase into next year's fiscal budget, and the change of the date also aligns the start of the increase with the start of the new fiscal year. Our actuary ran the projections around the proposed October 1 implementation date, and in the grand scheme of things, the change from the January 1, 2025 date to the October 1, 2025 date does not result in a significant moving of the needle. Having said all of that, trustees, let's start the discussion. I just wanted those points to be on the record because this issue has been reported in a way, the media way it kind of misrepresents the situation and you know what triggered the increase. Trustee Bowery, as former OMB director, you're first.
A couple of things. I'm concerned that I'm concerned that there's seem to be a narrative out there that, you know, the funding note solved all our problems, and we should be satisfied and go away. And you know, so I'm very concerned about that.
And that was the gist of our presentation to the governor when we met with him. That's what we had the actuary there to show that, you know, yes, the SPV did pull us from the edge of the cliff, but it didn't solve the insolvency problem, you know. And that's why I went through the labor of putting those points on the record, you know, like I made in my statement, even if we had gotten all that money on day one, we still would have had an unfunded liability of $1 billion.
Yeah, I you know, I mean, the liability doesn't have to be totally funded to be sustainable, but you know, so I'm concerned about that. I mean, all the analysis that was done on our side in terms of the impact of the funding note assume that 3% increase. We built that into all the analysis that we did, that you know, in respect to the impact of the note. And so that's one thing. The other thing is that the note isn't providing what was anticipated because of the issue with the cover over rate. You know, the whole analysis and was done not just for our side of the thing, but also for the other things that were involved in the note. I mean, people forget that that whole issue that gave us the funding, the $3.8 billion funding, was part of a bigger package that included bonds and two different bond issues. So, and the fact is that, so now we're not getting the funding, the full amount of the funding note that we expected. And the developments, the political developments on the mainland, which doesn't give any hope or any comfort, I should say. Maybe there's some hope, but it's not comfort. That we get the 1325. I mean, just to be realistic about it, the 1325 requires the Congress. It requires a vote of Congress, and to some extent, it requires the assistance of the president. And I don't know. We all know the role that our delegate played a couple of years back in terms of the incoming president. So I don't think. I mean, there again, I don't have any comfort. I mean, so I'm concerned that we may not get that thing go back to 1325. And so that's a double whammy. The double whammy is to the low rate from the low cash from the note, plus the 3% that we also built in on all analysis. So that's two setbacks as far as the long-term sustainability of the system that we were looking at. So, and then we've also, as you know, we also asked for the legislature to fund the administrative expenses of the system, given the fact that we weren't getting what we expected to get from the note, and that was turned down. So I also know, I think we have to admit that the government is in a tight fiscal condition. I myself have been writing about that for a long time. So I'm aware of the fiscal condition of the government itself. But as a board member, my primary responsibility is to the system and to the membership of the system. That's where my fiduciary responsibility is. So I'd like to say that I mean, I'm definitely not prepared to rescind the increase. I mean, I think in the interest of and in acknowledgement of the government's own fiscal condition, I'm willing to support your position that we delay it until October 1 as opposed to beginning of the next fiscal year. So I'm prepared to that. I'm definitely not prepared to withdraw it totally. I would support you. I'd support a resolution or a vote to delay the implementation until October 1. But I needed to get on record that, I mean, that the combination of the lower payout from the note and not being able to implement the 3% is that's a compounding combination there that should be very concerning to us as board members. So, I mean, I don't know. I think that's kind of sums up my situation. I mean, I'm concerned about the sentiment that's going on that, we're getting $3.8 billion and don't come back. So I'm happy that you made the case that the 3.8 billion. I mean, and we've said that before. We've shown before the legislature, even $3.8 billion, not only did it fund fully, but they're 12 years out. There's some years when the annual amount drops below, put us below a situation where we have a problem, Even though the $3.8 billion in total is a substantial amount of money, no question about that. But the way it's handed out, meted out, is problematic. So we know that. I think we need to be, my position would be that the best case is to would be to I'll be prepared to support a delay until October 1, but absolutely don't support that we send it all together. I mean, we need to have it. System needs it, I mean, I mentioned, are we going to see the presentation from at least to show the impact?
From Siegel, with
Yeah.
Aldrin. I defer to the chairman, I imagine so, but to your point, Trustee Bory, I think we should also note that $3.8 billion pledged over 30 years is not $3.8 billion in present value dollars.
Right. I mean, that's embodied in, I think that's embodied in the initial point that what's his name made, that the $3.8 billion didn't fully fund the unfunded liability. But the analysis that showed that was done, the graphs that was done by Siegel show dipping below the margin, below the 0 point, 10, 12 years from now, and coming back up. And by the way, I don't understand the concept of coming back up after insolvency. How do you get back up after insolvency? Once you dip below the line and you become insolvent, 3 years from now you're back up. You're out of business then. So I'm not sure I understand that the message that's sending. It's send a message that we'll dip into the negative in 2037 and come back up.
Resurrection.
After you've crashed. I see Aldwin is well seat belted. He's preparing for, I don't know, hopefully not a crash.
So I mean, once we dip below the negative point and become insolvent, anything after that is I don't know what to say about that.
Mr. Chairman, shall Aldwin proceed with his presentation?
Yes.
He seems to be frozen.
But while you look for that, I think it's important that we show that to make the case for why it's important for us to stick with the 3%. And I had a question for the legal counsel. I'm not sure if it's appropriate to ask it in this session, but question is, what would happen if the legislature doesn't appropriate the additional $13 million?
Alderman is back.
Sorry about that. I'm crossing the George Washington Bridge, so I think the connection here is not that great. So do you want me to bring up the presentation?
Point of information, Chair.
Well, hold up, Dorsey.
Oh, okay.
Alvin, you driving?
No, my
Oh.
wife is driving.
Oh,
Sorry.
I was about to
I'm
say.
That's what I'm saying. Yeah, I was gonna ask the same
Yeah,
question.
yeah, bring nothing on driving.
But then I saw him on the seatbelt, so.
No, I'm good.
Dorsey, what's the point of information?
I didn't hear the answer from council to the trustees' question.
He didn't answer.
Yeah, but I'm looking for an answer from the council, the board council. I'm looking for an answer before we start.
The same thing. Remember when we did the SPV, we had a pending case over contribution of wine paid. I mean, they don't.
I just wanted it on record here, not from you, but from the board council. That's okay.
You're muted, Pedro.
Attorney Williams, your device muted.
Yeah, I'm sorry. I was trying to find the right button. What happens if the legislature does not appropriate the monies? The obligation remains. The law provides that it's a continuing obligation of the government, and under Section 734 and under Section 736, the law provides that the employer can refuse or fail to pay the contribution, but subsection B provides that if they do, then the interest accrues. So the obligation, the $14 million that pursuant to the governor's letter, would remain a obligation of the government. And if they don't pay it at some point, the system may have to consider litigation.
I remember we went to litigation route before, but a couple of years back, when I first joined the board. We had some extended litigation against the government. If I recall, it went as far as the Third Circuit. You recall that? Those litigations?
Yes, sir.
I recall that the Third Circuit, at least one of the judges in the Third Circuit had ruled that the court, even if the court ruled in our favor and felt that the government had an obligation, that the court had no authority to force the legislature. The court cannot force the legislature to make an appropriation. You recall that?
Well, I think it's correct that the court cannot force the legislature to make an appropriation. What the court did indicate is that they expect that all the parties would operate in good faith and certainly comply with the court's order. And subject to correction, I want to believe that the government did pay the 40-something or whatever the amount was $1 million that the court did order. But I'll defer to either counsel for the system or the CEO. That has been my understanding, that the government did comply and pay those amounts that the court ordered.
Okay, I don't recall that, but
that's correct. The government didn't pay.
Okay.
Yeah.
But so that's kind of where it's coming from in terms of the looking down the road. I mean, even if the board sticks to its position and says we want 3%, 3 percentage point, the legislature still have the authority. What would happen if the legislature just said, well, we're not appropriating the money for that? Anyway, just wondering. I guess we could move forward, Mr. Chairman.
Can we move forward, Mr. Dorsey? You good?
Well, I was asking, I wanted to ask council now. I'm asking in reference to the same point. So this is a lot less money. So this is like 13, 14 million. You were talking about 40 plus million that the government ended up paying. Over what time did they pay that money? Maybe Attorney Myers could answer that for the system. Attorney Myers?
The money that you're
Yeah,
referring
you
to,
talk.
Trustee Dorsey, are you referring to the 13 to 14 million dollars that the 3 percentage points would represent?
No.
No. The case that
The 40 million. Oh, okay.
Yeah, the 40
Just
million.
wanted to clarify.
I was asking Attorney Myers over what period of time was it paid?
I do not remember. I'll have to check. I honestly don't remember right now, but it was paid.
Okay.
Trustee Dorsey, I can't hear you. You're muted.
You muted. You're mute, Dorsey.
Can you hear me now?
Yes, sir.
Yeah, I heard you, Attorney Myers. So Trustee Bory, is it that your position is we need to move forward with this 3% in the court, or just go back to the October?
No, we're not getting to, no, I'm not going to the court, no.
Okay. So
we won't get it any sooner if we go to court than October 30th. So
yeah.
no, sorry, I didn't need to. This becoming a distraction to the topic. So
Yeah. Okay. Thank you, Chair.
Okay, Alvin, you're free to proceed.
Yeah, before I start with the presentation that was requested, I was just gonna respond to Trustee Bowery earlier when you mentioned, how come like we go insolvent and we go back up. The projections basically presume that when we get into those insolvency period, the government is going to have to step in to pay the shortfall in order to make sure that members are going to continue receiving the full benefits. And so that's really why, basically at that point in time, the system is going to be on a pay-as-you-go basis until we get to the point where the funding note starts contributing enough so that we have a positive cash flow. So that's really what's happening there.
okay.
Does that make sense?
Yeah. The question is if they don't want to pay the 3%, they can't pay the 3% increase, how are they going to pay the 100%?
That's all I'm gonna say. The same thing. They can't pay the 3%. How them pay that?
Anyway, okay.
Right. I mean, it ends up being, whether you pay it now or you pay it
Pay now or pay later, exactly.
Yeah. So, so the very first chart that I want to show you is basically starting off from where we left off from the board retreat. So that blue line that you see over here, that's the projection that we last saw from the board retreat, assuming that we were actually going to get the 1325 and no shortfall starting in 2024 and 2025. And this still assumes a 23.5% contribution rate without the 3% increase. As you can see here, we're still remaining solvent over the period, but over that period of time up to 2038, it goes below 200 million before it starts to go up again. The latest projection, what we did is, after the board retreat, we had a few other tweaks in the data, but the most important update since the board retreat is the receipt of the October 2024 funding note, which was $56 million short of what was projected or what was anticipated. And so that's really what this purple line is showing. And that purple line is showing, while it's showing that, you're still solvent over the period of time, it is really dangerously close to the bottom there. In 2038, it's basically 15.7 million. Now, when we're looking at these assets, these are basically all of your assets, which include some of the assets that may not be fully liquid. So even though this projection looks like, you are still remaining to be solvent, in reality, once we're getting close to 2035, 2036, you may not have enough available assets to actually pay out benefits. But so that's just for illustration, showing that we're pretty much at the at the bottom of the projection here. So this is assuming that we're getting the 1325, and it's just showing the impact of the $56 million shortfall. Now, what happens? Question is like, what happens if we don't?
Yes, Sam, excuse me. This shows the 1325 and the 3%.
No, this doesn't have the 3% increase.
Okay,
yet.
okay.
All right, so let me, sorry. There's a little bit of a lag in moving the slides here.
I really cannot hear Alvin.
Can you hear me now, Leona?
Yes, a little bit.
Okay, I'm trying to move. Okay, so, all right. So what we did, we looked at what if the funding note never goes back up to 1325 and all we get is the 1050. Now, just a big caveat to this, even if at the 1050, we don't exactly know exactly what's going to be the shortfall. In a couple of years ago, when we were working with the governor's financial team, when we found out about the 1050, we were given some projections of the shortfall, and the shortfall was going to be somewhere between $20 to $29 million over that 30-year period. As we saw the last 2 years, the shortfall has actually been pretty much actually bigger than that. And so when we're doing this projection, just keep that in mind, that when we're looking at the 1050,
Yeah,
Yeah, you froze.
Yeah, it's frozen.
Chair. Hello?
Yeah,
Chair?
Dawson. Go ahead, Trustee Dawson.
You might have to call him and have him just pull over to do his presentation when he gets in a location that he can communicate.
I don't have his number. The CEO.
Yes, I'll reach out. I'm sure he's trying to get back in.
Now, Mr. Chair, in the interim, I agree with your bullet points, not to rescind, but to push it back until October 1. The request from Governor Bryan.
All right, thank you. Anybody else want to weigh in on that specifically?
I also, Chair, agree with the bullet points, and I also agree pushing it back to the October date as well.
Trustee Russell.
I have a different view.
All right, share it with us.
That I don't think our delegate and the governor has aggressively pursued the increase. After the election, the Republicans ain't gonna give us nothing. So you got to go really hard if you're Democrats, with a Democratic administration and a Democratic Congress. So I would delay making the decision until they show us that they aggressively trying to get the $13, and then delay our decision till next year. And I agree with postponing it, delaying it, but not just like so, because the legislature and the governor, to me, didn't pay attention to some of our concerns when you went before them, when NIBS went before them. And so, you know, we are independent body and we want government, but we could apply some pressure here to get them to aggressively go to the president, the administration, while they're Democrats, and see if they can pass in a lame duck session what we need for the special purpose vehicle. So that's my view.
Okay, I have a clarifying.
Mr. Chairman, Aldwin is back incidentally.
Okay. So we'll Russell, we pick up after Alvin finish.
Yes.
I'm sorry, everyone. Hopefully, I'm gonna turn off my camera, so hopefully that will help. So I'm not exactly sure where I dropped off. So what we're looking at here now is two sets of projections. This projection is basically assuming that we're never gonna get back to 1325. We're only gonna get 1050. As I started indicating earlier, I'm not sure if I was cut off. In a couple of years ago, when we were working with the governor's financial team, and we found out about the issue of the 1050, they gave us some projections on how much the shortfall could possibly be over the next 30 years. And that's what we're using here. And in those projections, they were telling us that the shortfall is going to be somewhere between $20 to $29 million per year over the next 30 years. However, as we saw in the last 2 years, the shortfall has actually been more than that, especially this last one in 2024. So I just want to caveat all these projections here to the extent that the amount of shortfall is larger, especially in the earlier years. There's the impact on the insolvency period or when the insolvency can first occur could be significantly different. But looking at this chart, the blue line here is assuming that we don't have the extra 3%. We're still getting only 23% of payroll. As you can see, the insolvency period starts in 2032. And during that period, basically will become a pay-as-you-go system until sometime in 2040 when it goes back up. And 2040 is really the year where the amount that we're getting from the funding note goes back up to somewhere between 120 or 158 million dollars. And that's why, that's when we really see the assets to go back up, because at that point in time, we're going to be cash flow positive the same way that we're cash flow positive in the past 2 years, and also for the upcoming year, where we still have 100, or we were supposed to get 150 million, but we only got 101 million. So as you can see here, even with the 3% increase, we're still projected to have an insolvency period from 2033 to 2039. It has an impact of delaying that insolvency by about a year. Instead of 2032, it'll be around 2033. But again, as I said earlier, when we're doing this market value of assets, we're taking into account everything, including your real assets that may not really be liquidated in time. So once we get to in this case, like somewhere around 2028, 2029, where we're below 200 million, that's dangerously close to where we would possibly need some additional contributions from the government in order to make sure that we continue to pay 100% of the benefits, because we may at that point in time that amount of assets is really just the Havenside Mall and other real assets that we cannot really just liquidate, like stocks and bonds.
Alvin, in terms of running out of cash, we're looking at 2030, 2031, is that what we're looking at?
Yeah, we're looking at yeah, probably around, well, I'd say probably 2030.
Okay. And so that gets to some, I know the point I was making earlier about how do you, let's say we sell, even if we sell everything, you're talking about from 2033, we're underwater at that point.
Right.
Somebody gonna have to hold in the breath for a long time to come back up in 10 years from 10 years after that. So,
Unfortunately,
so
yes.
in that case, then the government, for the government to keep it afloat, they would have to be looking at about $150 million a year instead of the 14 I'm talking about.
Yeah, so in the next slide here, I've just summarized all the scenarios that we did, right? So the chart that we were just looking at is basically the right side. So the middle one where it says 23.5% of payroll, we have that projected insolvency period between 2032 to 2039. The silver lining is at some point, right? If we're pay as you go during that period, and we actually get some cash from the government to pay, the benefits 100%. At some point, we'll be cash flow positive, and if we project all the way out to 2052, we actually can go back all the way to $1 billion. Because at that point in time, the program is going to have a lot more of the tier 2 retirees, so our benefit payouts are going to be actually much less compared to what we have now. The problem is, in order to get there, the additional contributions we're going to need from the government, from the general revenues, is going to be about $486 million during that period, from 2032 to 2039. And that's probably understated because, as I said, like in terms of like losing liquidity, you're probably losing liquidity 2 years earlier, not really 2032. You probably are going to need some cash because you're not going to be able to liquidate everything by 2032.
Yeah, so that's the point I was trying to make. So and when you get some free time, if you could do an analysis, I'd like to be able to say to whoever would listen, how much more the government will have to be paying in if we allow to if the system gets to this point per year.
Pay as you go, you're referring to.
Huh?
Pay as you go during that
Yeah,
period.
yeah. I mean,
As you
if
go.
Squawk is squawking about an additional $14 million now, think about what we'll have to come up with if the system is allowed to dip below the line,
Mhm.
whatever year that is. It's either that or the system don't.
Yeah, I mean, actually, if we didn't go into a lot of that analysis. I mean, if we look at it, it's probably going to be even more expensive for them because, if you're paying later, it's a much bigger problem. Whereas if you're paying it now, additional 14 million, or in this case, I think we're going to need more than 14 million if we're actually not going to get the 1050 back to 1325. If you pay now, if you get the money now, you also have the ability to invest that money and in essence make it make it cheaper in funding the benefits as opposed to a pay as you go. Pay as you go is always going to be more expensive.
Mhm. Okay.
But I think one of the exercises that we were trying to do here was just what's the difference between January 1st, 2025 and delaying it to October 1st, 2025. There's really not much a difference, right? So the projected insolvency period is basically going to be about the same. If we talk about that 9 months, it's really $10 million of contributions that we're foregoing in addition. So as you can see, because we have the same period that we're going to be pay as you go, and same year in which you were gonna come back outside side of insolvency, the projected assets by 2052 is essentially the same between the two scenarios. But in terms of the additional contributions from general revenues, there's a little bit of more that the governor is going to have to pay if they delay it by 9 months, because we're going to be projected to become insolvent a little bit earlier, probably a few months earlier. So that's the last row that you see there, the 253 million versus 266 million.
Okay.
Thank you for that. Any trustees have any additional questions for the actuary?
Chair, I have a question. So basically, this is based on the 1050. But if we were at the 1325, then I guess you're saying we would be all right then, if we were there all and getting the revenues that we haven't received up to this point, along with the returns on our investment that we currently are receiving.
Yeah, we will be in a much better position.
Yeah.
We still get dangerously close. I mean, 15.7 million is the low. It's really, like I said, in here, you're probably gonna have a temporary insolvency 2 years before, because that 15.7 million really represent some assets that you can't liquidate.
Right. Okay, well.
But this is where, so the first two here, this is kind of where I think from the board retreat, what we were saying, if we can just get that 3% and have the government pay the administrative expenses, we're actually in a pretty good spot.
Right. All right, well, I don't have much more to say. I wasn't part of that meeting, so I guess you guys supposedly cover what you needed to cover in the meeting with the governor. So
piggybacking on Trustee Dorsey's concern, and I'm sorry to be the skunk at the party, but while we're focused on the cover over rate, we do need to remember that the cover over revenue is a function of the rate and rum production. And I suspect that there may be a trending downward of, if not rum production, then certainly rum exports to the United States, because like anything else, is a matter of taste. And rum may not be predominant at this point compared to what people are drinking is. So I've asked for some information regarding volumes so that we can get under the hood and see that as well. But I think that we need not lose sight of the fact that maybe rum production in and of itself is becoming a problem as well.
Yeah, the other thing to consider is the fact that in the flow of funds from the note, the GRS is like in the bottom bucket.
Right. So if you reduce it from the top on the waterfall, based either on the rate, the cover over rate, or on production, then if you're the last man on the totem pole, that tells you you're getting even less, right?
Yeah, the top of the totem pole is bonds, some government bonds, and those get taken care of first at the full amount.
Mm-hmm.
So they have I don't, if I recall, there's some government bonds, and then there's the rum companies bonds, and there's some other
incentives,
the rum incentive package. All those are legally binding responsibility that they get taken care of in total first, regardless of what they think.
And the reason I interject that is not to be alarmist, but so that we can be clear-eyed with what we're looking at.
Mm-hmm. Yeah.
Well, I would say this. When we were at the retreat, I can't remember the gentleman's name.
Brian Gardner.
He indicated he represented the government. And at one point in his mind, he thought he represented us as well as a system until there was clarification made in the room. And I can't remember who made that point. But at the end of that segment, he indicated that we're an independent group, as was said earlier tonight, and we need to have our own representation going to DC. He made that point clear. As everybody knows, we did attempt to do that. We voted on it. We got the okay, but we never went through for, I don't know if it was the COVID, I don't know. I can't remember all the other details why we didn't move forward, but I see the situation as half full. I don't see this as, I'm not even harping on the 1050. I still think that when the next administration gets in, unlike our former trustee indicated, I still think we need to confront with our own representation as a board of our situation, because just to say no and not make an attempt because someone else is in office, I just don't see it that way. I would like to be able to at least go and have that conversation face to face, not necessarily to our representative. As was indicated, we know what that history is with this particular new president coming in. But I'm just saying from the system standpoint, as trustees, we represent the memberships, the actives, and the retirees. So my position is, I think we should go back to what we did vote on previously and speak with the president directly to let him know what our situation is, because we have issues here. But you know, this is a very critical function of what we do as a government and what we do, you know, as a territory. This is a very critical issue. So I think we need to go back there. I definitely see it half full. I don't have no problem sitting across the table from the new president. I think that we might get some leverage. We might be surprised and get more than what we were asking for. But to do nothing, we're definitely going to get nothing because we didn't do anything. But I wouldn't just say not to try. When we had in our retreat, the individual that came in, I guess, as the CEO said, Mr. Gardner, that we need to go do our due diligence and represent ourselves because no one's been representing us. So I think from that standpoint, that's the leverage I would go with. If it was up to me on a vote, I think it should be a board position to do that. And I think it should be the board to go. I don't feel it should just be the CEO and the chair to go. I think in this case, because we are speaking to the president, we have our own delegation, which would be all of us as trustees speaking in that forum. So that's my position on that.
Just for some clarification, when you say we're independent body, what do you mean?
Well, when we were at the retreat,
you said in your presentation that we are independent. What does that mean?
We're a semi-autonomous agency within the government structure. So the individual who was speaking, we were speaking about cover over. He represented the government, he said. I'm explaining my position as being independent. He indicated that we need to have our own independent representative or representatives.
So we're independent because he said so? We're independent because he said so? That is what you're saying?
To go to Washington.
We're independent because the guy said so? Is that what you're saying?
No.
Oh,
I'm not sure if you were online or not at that point, Trustee Borey, but the individual said to us in the room that he does not represent us or represent our interests in the cover over program. That's what he indicated to us, because he was first saying that he represented us because he was saying he represented the government of the Virgin Islands. But what we found out, he's hired by Government House through maybe the Public Finance Authority to do whatever work he's doing on behalf of the government, but not necessarily on behalf of the GERS. We had mentioned before that we had a vote where we voted to go to DC to speak on our behalf to try to get the not just to cover over monies to help the territory and our constituents from that standpoint. We never followed through for whatever reason. I can't remember what the reasons was. So from that standpoint is what I mean by an independent. Independent meaning that we would go from a GERS standpoint as a board to speak to the president. We voted on it, but we never did it with this current president for whatever reason. That didn't happen. And I just don't remember why. Maybe somebody else remembers why it didn't happen, but it didn't happen. But we did vote in favor of going to speak to the president. Now we have a new president coming in. Some people might feel it would be a waste of time to do it, but I don't feel that way because I see the glass as half full. And until we get in front of the president, the opportunity to get in front of the president, and he says no, or he might say yes, and what else do you need? So we're not there yet, but I'm just saying if we're going to move forward, I think we need to go back down that road. We need to leave all our options open. So that's one of the main things I got out of the retreat we just had a few months ago, several months ago, as well as the 3% increase that our plan was doing well. If the market keeps up as it is right now, we were doing well with that, even though we're at the 1050 level with the cover over. I've always said that we've never, or at least I haven't gotten access to all the documents. So I'm still at a disadvantage when it comes to the special purpose vehicle. Yeah, I've seen a bond note, but that's not what I want to look at. I want to look at the entire package to have a face-to-face with the government, in this case, the plan sponsor, and have those kind of discussions. That's where I sit. So I haven't changed from that position because I'm still at a disadvantage. Maybe other people on the board have seen those documents, but I have not seen those documents. And the note itself is not what I'm looking at. I want to look at the entire package of the special purpose vehicle and then have a different discussion, because things are written in those documents. It doesn't mean they can't be changed for different reasons locally, especially starting with the two rum companies, but we just haven't gotten to that point. At least I haven't gotten the documents to review. And that was another discussion I would have liked us to have as a board, to speak to the two rum companies to see if there's any communications we could at least start to have to give them our position from a retirement system standpoint as to where we're at. So, and that would be in conjunction with the EDC program, Mr. Biggs program, when we have that conversation. So that would be like a group approach, which was recently, well, not recently, but maybe over 2 years ago or a year ago, recommended by one of our other people we're doing business with. That's all I'll say. I wouldn't put the name on record at this point, but that was recommended. So I still think we have an opportunity to change the course of the direction, even though we're pushing back or looking to push back the 3%. I still think we have some opportunities. I know we still have the 2 pieces of land in each district that are been undeveloped. And I know we were trying to push that to a next level, and then that, I'm not sure where that is. I know it came to a stop. Maybe the CEO can speak about it. Maybe there's something else going on that hasn't gotten to the trustees yet. But we were making a valid effort to make those 2 properties, to develop those 2 properties, to create additional income for the system. So right now they're sitting on the books, and they're sitting as just vacant land. So I'm still saying we have options. I'm not sure, other than pushing back to 3% proposed, what else we're looking to do. But like I said, the investments are doing well. So we've been blessed with that part, at least. So we got that right. So I didn't have anything else on that, Chair.
All right. Anything else regarding the agenda item we're discussing, which is the implementation of the 3% employer contribution rate increase? Trustee Russell.
Yes.
Okay, so in when you were giving your position, you mentioned something about delaying until next year. I wanted to expound on that. I wasn't really clear on what you were saying.
Okay, I support what Trustee Darcy said, and I was to the retreat when the guy basically said the government and the GRS represent two different interests regarding the run cover over. Different in terms of we rely on it for solvency, and the governor and the government relies on it to pay debts. So, you know, it's fine. It's a good arrangement. So I am on board with Dorsey, where we make an attempt to advocate and promote the increase in the rum cover over while we still have a democratic administration in power. Take one last attempt, and maybe we could include our delegate and she could sponsor us, you know, meeting with, and in the lame duck session, they could do something for us.
Okay.
That was where I was.
Okay, so let me point this out, because through a lot of the discussion, I think we started to mix up apples and oranges. What is before us is a 3% increase, right? Which is not, that don't have nothing to do with the cover over, and this is why I went through making those points, because even when we passed the resolution originally, and it was reported in the media, it was reported that we passed this increase because of the shortage of the rum cover over money, where we know that because the SPV did not totally solve the insolvency issue, we had already built in that, okay, come January 2025, and every 5 years thereafter, we will increase the employer contribution rate by 3%. So it's not, the resolution wasn't a result of the shortage of the rum cover over money. So I don't want that we're talking about what before us now is a proposal to push back the implementation date, and all we're talking about is the rum cover over money, because that then I gave it the impression that they both are connected, like one was a consequence of the other, and that's not the case. So I'm not disputing what you're saying. I'm just saying that it's two separate issues, and I don't want to convolute them.
Okay, just let me say this. To me, they convoluted, Mr. Chairman, because our responsibility is to the system. When we made a decision to help the system along, the legislature and the governor ain't support us. When we went to the legislature for 15 million or contributions to, however, we were trying to get money from the legislature, we didn't get support on that. And I believe that we got to take that into account. We got to take the politics into account, because it is directly affecting our responsibility as fiduciaries.
Okay.
So I am not willing to rescind not now unless we get on the same page with the run cover over, we get on the same page as what the system might need, and we get on the same page in how both government and GRS could move forward. I don't feel that's how we're going.
Okay, so your point is on record, and I'm going to counter with this point. So you can't penalize the legislature because they didn't support us with our request for the $15 million to fund the administrative costs of the system. If you're going to penalize them for that, then you have to reward them for the SPV.
The SPV didn't come from the legislature.
Oh, where who it come from?
No, wait, the SPV idea. And we could go back there, but listen to me. It's not combative, and I don't want to make it so
No, we're
combative.
not.
Okay?
Okay.
It's politics.
So, okay.
And
okay.
if they play politics with the very serious request that was put forth by Mr. Nibbs and then again by Mr. Dawson, then play the politics all the way.
Well, and that's what I'm saying. So we penalizing them for that.
Not I'm penalizing them, we just getting them to
You're
be
holding against
responsive to our needs.
You're holding against them the fact that they're not cover the administrative costs. So I'm saying if you're gonna say one, they got to say two. So to do the SPV, you got to give them credit for that.
Well, the SPDV
I'm
one
just
day.
saying.
Yeah,
Right.
but I'm talking about this. I'm talking about this fiscal year, and my view is my view. I would delay moving it until we could get some kind of concerted effort between government and GERS to really try to get that $13 figure out of Congress.
Okay.
And if we make a gallant effort, I could support the delay, but I don't feel we're making a gallant effort, and I don't feel that we one team going for that. I don't feel that way. So,
Okay,
you know,
noted. Your position is noted. All right. So can I have a motion to modify the resolution concerning the employer contribution rate to delay the implementation date, to change the implementation date from January 1, 2025 to October 2025. October 1, 2025.
So move.
Okay, moved by Dorsey. Is there a second?
Second.
Second by Smith. Can I have a roll call, please?
Yes, Mr. Chairman. Trustee Bowery?
Yes.
Trustee Bowery, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Liger, absent. Trustee Russell?
No.
Trustee Russell, no. Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Colwood?
Yes.
Trustee Colwood, yes. Mr. Chairman, 4 yea, 1 no, 1 absent.
All right. The motion carries. Can I have a motion to adjourn?
So move.
Moved by Trustee Dorsey. Is there a second?
Second.
Second by Trustee Russell. Have a roll call, please.
Trustee Bowery?
Yes.
Trustee Bowery, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Liger, absent. Trustee Russell?
Yes.
Trustee Russell, yes. Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Colwood?
Yes.
Trustee Colwood, yes. Mr. Chairman, 5 yea, 1 absent.
All right. This meeting is hereby adjourned. Thank you very much, ladies and gentlemen.
Thank
Well,
you.
Thank you.
Action is
Good
done.
night.
Good night, everybody.
Bye-bye.
Happy Thanksgiving.
Oh, yeah. Happy Thanksgiving.
Thank you. Happy Thanksgiving.